Okay, folks. So how many of you are jet lagged? I just want to find out, you know. Okay. You live. It's not the end of the world, right? It'll be a tough week, no matter what, right? You have to roll back into time. A couple of very quick announcements. One is the case I've been nagging you off and on. I left you alone. How many days? 9 days without an email, right? Yeah, see? So it's I kept my word. I was sorely tempted sometime in the middle to send you something, but I decided it wasn't good. But now that you're back, I have to hit you again. So one of the things I've been nagging you about is the case. And I did make this very helpful suggestion last night that you read the case before today's class, which I'm sure you've all taken to heart. If you have, there's going to be a payoff. Because I'm not going to talk about the case. In fact, I will not talk about the case till the day it's due. But I will talk about concepts that will kind of attach themselves to the case, right? So that's why I suggested you read it, because as we go through class today, maybe you'll have that aha moment. That's how I deal with that aspect of the case. There was one typo on the case, which was... this is okay if you haven't read the case at all. It's about a company called Netflix, in case you haven't heard about it. Investing in a studio. Anybody remember how much the studio costs up front? One is this time issue. Notice how time becomes this kind of difficult concept to deal with. And I have to be very careful. Upfront means right now. And then I have to be specific, a year from now, 2 years. Because why does it matter? Because as we'll see today, time value of money requires that you attach cash flows to time. I think it was $1 billion. And in the original version of the case, do you remember what the salvage value was? $200 billion. This was your chance to get the case done right away. Because what's the question you have to answer? Should Netflix invest? 24 hours after I put the case up, you should have sent the solution back. Of course. You invest $1 billion right now and you get $200 billion back in 10 years. The rest of the facts are kind of irrelevant, and I'd have had to give you a 10. But that chance come and gone. So think of that as a window of opportunity that opened to you that you did not take advantage of. So now you have a much more messy process. The only suggestion I would have for you on the case is keep your eyes on what's changing, not on what doesn't change. It sounds like one of those Buddhist sayings. You know, think about it for a moment and you'll see very quickly because there are a lot of distractions in the case, right? Because I gave you stuff about the company and I gave you stuff. Keep your focus on what you're trying to decide. Should Netflix open the studio? So today we're going to talk about the concept of incremental. And you're going to see it come very close to this notion of what should I be taking care of and what should I be just letting pass by. I know it's been a while since our last session, so let me bring you back to where we were that session, because many of you already had left on vacation, either physically, mentally, you were not quite here. But we started on looking at a new theme park for Disney in Rio. Okay? And I was describing this theme park. In fact, it's going to be 2 parks, a Magic Kingdom and an Epcot. And I'd given you the projected revenues at this theme park. These are estimates, right? So somebody, in a sense, is making these estimates of the future. Assume it's me, based on looking at Euro Disney and Disney World and Disneyland. These are my projected revenues. So that's going to be a big part of whether you should take this theme park, is what kind of revenues are you going to get. But let's complete the process. As I go through the facts to complete the process, I'm going to remind you again what your role is. Your role is to decide whether to take the project. I'm going to be the number cruncher. So let's look at the rest of the story. I've got the revenues, let's talk about expenses. Based on other theme parks that Disney has out there, it looks like the direct expenses associated with running this theme park will be about 60% of revenues. What does that mean? This is the actual cost of maintaining the theme park, the people around the theme park, the people cleaning up. So this is the actual cost of operating the theme park. 60% of the revenues in the theme parks, but 75% of the revenues in the hotel properties and the resorts around the theme park. What am I basing it on? Again, what I have on the ground. Okay? But then I'm going to add to this cost. Because this is a project for a large company, Disney is going to allocate some expenses to this theme park. It's going to allocate G&A. What the heck is G&A? I know the expanded version is general and administrative costs. What goes in there? I mean, you see tens, hundreds of millions for big companies. At the risk of sounding like I'm dismissive of this, G&A is any cost without a revenue attached to it. You know how when you work in large companies, you see these large groups of people, you have no idea what they do. They just come in and go, entire floors being filled up. There's no revenue attached to them. They're cost centers. And what accountants do is they gather these costs together, and it drives them crazy. So what do they look for? They look for revenues to attach these costs. They say, you look like you have lots of revenues. Here's the cost. So this particular project is going to attract attention because it has revenue. So the accountant says, you look like you have revenues. So they're going to allocate G&A based on those revenues. So they're going to say G&A is going to be 15% of revenues each year. Now, does this sound fair? Because what am I doing? I'm attaching a portion of Bob Iger's salary to you, right? I'm saying, hey, you know what? You're part of a big company. Whether it's fair or not, it happens at most companies. And I'm going to add a qualifier to this. 2/3 of these expenses have nothing to do with this theme park. Now that Buddhist saying up front should be playing in the back of your head, right? 2/3 of these costs have nothing to do with the theme park. You're saying, why are they allocating it? Because they're accountants. The costs have to go somewhere. So 2/3 of these expenses have nothing to do. 1/3, you can argue, or more accountants, even if they're hired in Burbank, are part of this theme park's burden. So those are the two costs. Then comes that big capital expenditure I have up front. Remember the 2 theme parks that I built? Those are treated as capital expenditures. Essentially what they are assets I invest in up front, which I now have to depreciate. This is the schedule that I'm going to use to depreciate those assets. And you're saying, where does that schedule come from? Increasingly in the US, if you are a company that buys an asset, the IRS supplies you with a schedule that tells you this is the % you can write off. It used to be 30 years ago that you had discretion. You could pick different depreciation methods. But the IRS got sick and tired of game playing on depreciation methods and said, we're going to take it out of your hands. So that's how much of the book value you can depreciate each year. And then in the second column, I have an item called capital maintenance. You're saying, what is that? I know depreciation is an accounting number. But if you step back and think about why we depreciate assets, what exactly if I replace accounting depreciation with economic depreciation, what exactly are we talking about when we're saying an asset depreciates? I'm sorry? It's getting older, but older by itself is not a problem for me, right? But it's getting older and it's getting less efficient. It's in a theme park, you know what this will look like, right? Your rides are going to look older and older and older, of a movie that nobody even remembers anymore. And maybe kids don't even want to get on this ride anymore. So, and you can see when you go into a mall, you can tell which retailers set aside money for capital maintenance, which ones don't. You can go to the mall, the first day it's open, they all look the same, they all look new. 5 years later, you go into the same mall, some stores still look like they're refreshed. And some stores look absolutely crappy. So what I'm going to do is every year when I depreciate, remember that's because it's an accounting expense, it saves me cash. I'm going to put some of that back into the business. Why? Because I want my theme park to keep going. So here there is a link between what I assume this theme park will last for. So if I say, at the end of 10 years, I'm going to shut this theme park down, I don't care what happens, then obviously, But given that I want this theme park to keep going, I have to act like it's going to keep going. Capital maintenance is what I'm doing to keep the theme park looking good. So the way to think about this isn't maintenance in the traditional sense of the word. Equipment being kept up to date. This is capital maintenance, replacing an old ride with a new ride. The kinds of things, for instance, Disney is doing right now in Disneyland, where it's building a new Star Wars. That wasn't part of the original investment, but you have to keep doing stuff like this to get your people to keep coming back. So the capital maintenance initially I let stay below the depreciation number, because initially it's pretty new. And as the theme park ages, I start to invest more and more. Why? Because I want the theme park to keep going. So here's the rest of the assumptions. Working capital. I mean, we know the accounting definition of working capital, right? Current assets minus current liabilities. It's easy to forget what that even means. But I'll give you my perspective on working capital. Working capital is tied up cash. It's cash tied up in inventory or accounts receivable you can't use elsewhere. That's why we care. Because it ties up cash, it affects your cash flows. So in this particular case, I'm going to assume that working capital will be 5% of revenues. Notice a pattern with all my assumptions. What have I stated these items as a percentage of? Why do I state it as a percent of revenues? Because if I change my mind then and change my revenues, everything ripples through. If you've never done model building, here's a simple suggestion I have for you. As you build models, whether it's an Excel spreadsheet in small form or big form, tie your line items to something basic. The reason being, if you hard-code numbers, you know what I mean by hard-code numbers? If you put 125 in year 3 in a cell, and then you change your mind and go back and change revenues, that 125 will stay at 125. So as best as you can, you want to make sure that your assumptions are tied to each other. That means if you change your mind, everything will change with it. And in this case, I'm also going to assume that the working capital that you need for this theme park, the inventory, the accounts receivable, happen at the end of each year. And you'll see the relevance of that when we start talking about cash flows. I'm going to assume that the income from this investment will be taxed at Disney's marginal tax rate of 36.1%, because it's going to be income at the margin. You ready? Here's what I'm going to do. I'm going to first take the assumptions I've given you and compute what the accountant would tell me I've got invested in this project every year. That's called book value. And here's what it looks like for this particular theme park. So notice up front I have that 500 million I've already spent. You're saying, but I've already spent it. The accountant doesn't care. It goes into your book value nevertheless. There's the additional investment I'm making in the new theme park. So you can see the capital invested starts climbing. And starting in year 2, I do 2 adjustments. One is I subtract our depreciation, because depreciation reduces your book value, and I add back that capital maintenance. So essentially the only things that change book value are depreciation and capital expenditures. And I've also included working capital as part of my capital invested because it's money tied up in the project. Take this with a grain of salt. This is the accountant's estimate of what you have invested in this theme park. So you ready? You're the decision maker. Here's the first table that should matter to you. You're saying, how much money will this theme park make for me? I made my best estimates. I took the revenues I projected 4 pages ago, and then I started subtracting out expenses. There's the 60% direct expense associated with the Magic Kingdom, the 75% with, the 60% with Epcot, the 75% with the resort properties, and I'm also subtracting our depreciation and allocated G&A. All of it. Why? Because this is an income statement. Later on we'll come back and talk, should I have done that? But at this point, I just want the accounting earnings in this theme park. And guess what? In year 1, my accounting income is a loss. It's minus 50 million. In year 2, it's minus 150 million. It should be no surprise. Year 1, there's nothing open, so I'm losing money. Year 2, I'm still losing money because I'm building stuff. And then year 3, I lose money, and year 4, excuse me. So if I asked an accountant what my break-even was, he'd say in year 4. That's when it's going to happen. Now take year 1 though. I'm losing 50 million, right? What's this minus 18 million in taxes that I'm showing in year 1? What am I assuming I'm doing in year 1? What are the 2 things I can do with the loss as a company? I'm sorry? Not pay tax is never an option. I have to do something, right? It's getting pretty close to April 15th. If I send a letter to the IRS saying I'm not paying taxes, even if I have a really good reason, I'm going to end up in trouble. So, yeah, what's the first thing I can do? I can carry my loss forward and offset it against income. Is that what I'm doing? If I were carrying my loss, I would show 0, 0, 0, right? What's the other thing I can do? It could be, but I haven't shown the balance sheet. But in the income statement, if I were doing this, but what's the other choice I have if this is a project for a large company? Remember, projects. Exactly. This is a project to a big company. This project doesn't file taxes. It's like my kids are loss-making entities in our family unit right now. I mean, I still love them, but they're loss-making units. But even though they're loss-making units, I report them as a composite family entity, and they're tax credits at the moment. Okay? I could say, wait till you start making taxes, but in this case, if I can get the tax savings now, I'd rather get the tax savings now. I know it's a choice, but if you have a choice, take the tax savings now. Don't wait 3 years. It might look more elegant on your accounting statements to push it forward. But in this case, you want the tax savings. I am assuming I get the tax savings in year 1, year 2. And if you ask me to back it up, you know what I'm going to show you? The income that Disney made elsewhere. You're saying, what kind of company will I not be able to do this in? What kinds of companies will I not be able to use this process? Want to try? Anybody? Yes? A company that's losing money. If you're a big-time money loser, then this option is off the table. Then I have to wait to get my tax savings in future years. But in this case, I'm going to claim the tax savings right away. So is Netflix making money? See, go back and check, right? If it's making money and you have losses on this project, you already have an indication. I said I'd never mention the case. Okay, never again after this, right? So think about that when you think about tax savings. So in year 1, if I take the tax savings into account, my after-tax operating loss is only $32 million, less than my pre-tax loss because I got the tax saving, and I do that every year. You ready? I come and put the sheet in front of you. What's your job? To tell me whether I should take this project. Is this project good enough? Should I take it? It's making a lot of money, $421 million. So why are you guys hesitating? Is $421 million a lot of money? It depends on what? On what you invested in this project, right? In the previous page, I showed you what the investment was. On this page, I've shown you the operating income. By itself, neither page allows you to answer the question. But if I pull them together on one page, I take the after-tax operating income from the last page and the invested capital from 2 pages ago, and I divide the after-tax operating income by the invested capital, I get what's called the return on invested capital, or the return on capital. And I know the numbers change every year, but the average return on capital on this particular project over the decade, over the next 10 years, is about 4.1 to 4.2%. As a decision maker, that's a number I'm giving you. It's a 4.1 to 4.2%. And the question I'm asking is this good enough? So you have to compare it to something, right? Let me give you some choices. You tell me which of these choices you would use as your comparison. So this project, if you believe the accounting numbers, has a 4.1 to 4.2% return on capital. It is higher than the T-bond rate. Is that good enough? Why is it not good enough? Because it's not risk-free. So I can't compare to the risk-free rate, saying I'm making more than the risk-free rate. This is great because it's not a high enough hurdle. I can give you the cost of equity for Disney as a company. Can I compare this 4.1 to 4.2% to the cost of equity? And if not, why not? We call the cost of equity a hurdle rate, right? So if it's a hurdle rate, I should be able to compare returns to it. But what are my returns? How did I compute the returns? What did I use? I used after-tax operating income, income before interest expenses, and divided by the invested capital, the total amount invested in the project. You're saying, so what? That's not a return to equity investors. That's a return to the entire company. A cost of equity is not the right hurdle rate if, in fact, the returns you're computing are returns to invested capital. So you see the cost of equity, the 2 cost of equity numbers, you can cross them out, not because they cannot be used as hurdle rate, but because of the way I computed my return on capital. What would I have had to do on the previous page for cost of equity to be a player in this game? How should I have computed my returns if I wanted to use the cost of equity instead? Instead of after-tax operating income, what should I have computed on this theme park? Net income. To do net income, what would I need to do? Estimate interest expenses on my debt, subtract out the interest expenses, come up with the net income. Perfectly okay. And that net income would have to be divided by not the book value of the invested capital, but the book value of the equity in that invested capital. So I'd have to subtract our debt. If I'd computed a return on equity on this project, then I could have used the cost of equity. I did not. I computed a return on invested capital. So you can cross out. Now comes a critical choice. So clearly it has to be a cost of capital I should be comparing it to. And we've answered this question already, but let's nail it down. Should I be comparing it to the cost of capital for Disney as a company or the cost of capital for Disney's theme parks? It should be theme parks, right? Remember that movie example, Lone Ranger 2? This is exactly why we broke the company down into its component parts. So the cost of capital I should be using for my comparison should be the cost of capital for Disney theme parks, 6.61%. Yes?
Will you as a decision maker ever want to use the cost of capital where you're thinking about both equity and the lenders?
Sure. Because my stewardship is of the business. If I focus purely on equity investors and I focus on delivering more return to equity investors, there are lots of games I can play, right? I can essentially think about, hey, how do I take advantage of the lenders? And you're right, in the short term, I'll keep equity investors happy, but in the long term, if I am playing that game, then when it unravels, as it inevitably will, you're going to have what's happening at Valiant right now. Which is, this is a company that was run for the equity investors, by the equity investors, off the equity investors. When things were going well, they were all happy. But now things are unraveling, you're seeing essentially the weaklings of how the company is being run. So you're right, my first instinct, keep the stockholders happy. But I also have to think about the ultimate objective, which is, I have to make this business a healthy business. If I'm keeping stockholders happy by taking advantage of lenders in some way, that's what will happen if I am taking project with the return equity is higher than the cost of equity, but the project itself doesn't pass muster. The only way that can happen is if I somehow was able to borrow money at too low a rate and take this project. So I agree with you. My first instinct is I want to keep stockholders happy, but if I'm running this business as a viable ongoing business, I'd like to keep both, actually. To be honest, I'd like a project to beat the cost of equity and the return on capital beat the cost of capital. And if I borrow money at a fair rate, that's exactly what will happen. It's only if I can take advantage of lenders that you're going to get a split verdict. And when you have a split verdict, my advice is do what's best for the company. Don't get too focused on this will keep stockholders happy in the short term. Okay? So the cost of capital that I would use is the cost of capital for the theme park. And already you're ready to make the decision, right? Don't quite, because I have two qualifiers I want to add. Because right now it doesn't look like a good project. 4.2%, 6.61%. Here's my first one. That 6.61% cost of capital reflects, in 2013, Disney's existing theme parks. And let me list out where they are. There's one in Anaheim, one in Orlando, one in Paris, one in Tokyo. Hong Kong had just come on. It actually hadn't even started impacting the numbers yet, but primarily those 4 theme parks. You think, so what? Where's the new theme park going to be? It's going to be in Rio. See what the next question for me is going to be? I know we're doing everything in US dollar terms, but if this theme park is going to be in Rio, should I be attaching something extra to my 6.61%? You think, obviously. In fact, let's think broadly. Whenever a company invests outside its borders, there are 2 risks it's exposed to, right? One is no matter where you're investing outside your borders, there's exchange rate risk, which you would not have had if you'd made the investment there. The second is what I'm going to call political risk. What's political risk? This is risk that it's not just that exchange rates will change, but that something bad could happen to your project that has nothing to do with exchange rates. Okay? I'll give you an example of where, when you think about political risk, what form this will take. And this is the 4th edition of my Applied Corporate Finance book, and in the first 2 editions of the book, that Rio Disney theme park was actually in Bangkok. You're saying, why do you move it to Rio? Because Disney very inconveniently opened the theme park in Hong Kong. I don't know why they never called me to ask me whether this was okay. But once they opened it in Hong Kong, I couldn't open a second theme park in Bangkok, so I had to move continents. Now all that Disney has to do to screw me up is to open Disney Sao Paulo. Then I have to jump to Africa, I guess, then what, Antarctica? I mean, I'll have to think of where I keep moving this, But Bangkok actually was a perfect example to talk about political risk, because I don't know whether you remember, in 2007, the Prime Minister of Thailand came over for the UN meetings in New York. They all tend to show that. That's when you know the traffic's going to be really bad. They shut off entire streets. See, while he was here, there was a coup back in Thailand. And he couldn't go back to Thailand. So let me pose a riddle to you. If a prime minister of a country leaves the country and cannot go back into the country, would you as a company invested in that country worry about being able to get your cash flows out of that country? That's it. That is political risk. That's why if this were a theme park in Frankfurt, I wouldn't blink an eye. It's dollar terms 6.61%. But because this is a theme park in Rio, I have to worry about the political risk. So it's not exchange rate risk that worries me. Exchange rate risk, not only can Disney take care of it, but its investors can take care of it. What am I talking about? Remember the top 17 list of investors, BlackRock, Fidelity. They have hundreds of companies, some of which are helped by the dollar, some are hurt by the dollar. They can take care of exchange rate risk, but it's the political risk that worries me, and I have to bring it into the discount rate. And we already have a way to do this. In fact, the reason we've approached discount rates the way we have is to allow me to be able to do this. And here's what I did. I went back to the original cost of equity calculation I had for Disney. Risk-free rate is in US dollars, so that stays at 2.75%. The beta is still a Disney theme park beta. I left it at 0.7537%. I'm sorry, 0.7537. But here's where I did things differently. In my original cost of equity for Disney, I used that weighted average of all the countries they operate in and used an equity risk premium of 5.76%. I replaced that with the risk premium for Brazil as a country. And in 2013, that number was 8.5%. That's a default spread scaled up for the additional risk of equity. So it's the same process we used to come up with country risk premiums in the first part of the class. That higher risk premium pushes up my cost of equity and pushes up my cost of capital from 6.61% to almost 8.5%. That's what my cost of capital is going to be for this theme park going forward. So you can see how this actually provides a template for our multinational. So if you're GE and I ask you what discount rate should I be using on my Indian appliance factory, let's say I decide to open a factory in India. What's the beta you're going to use? The beta for the appliance business. What risk premium are you going to use? You're going to use the risk premium for India because this is a... So in a sense, as long as you get to choose the beta and the risk premium, you can take a multinational and come up with a cost of equity or a cost of capital in pretty much any part of the world, in any currency, because the three pieces allow you complete control over the process. So my cost of capital for this particular theme park is about 8.5%. It's getting worse, right? Because your return on this particular theme park, even with your higher of the two numbers, is 4.18%. And it looks like this theme park is going to require 8.5% to break even. You get ready to put a big X across the theme park. Don't open it. It's a bad project. And I'm going to add my second qualifier. How many years did I project cash flows for this theme park? Yeah. Let me show you the 10 years. Okay. So I projected 10 years. Why did I stop after 10 years? My fallback is half of all projects in the US have 10-year lifetimes. Don't ask me why. Why 10? Why not 9? Why not 11? I don't know. Here, when I got here. Why 10 years? I wondered about this. What's so magical about 10? You see valuations with 10-year lifetimes, project with... I have my own quirky hypothesis for this. I think it's what fits comfortably going landscape in Excel on one page. I know it's completely absurd, and you now have shrink to fit in Excel. But shrink to fit is almost useless if you think about it, because I can shrink anything to fit on a page, but nobody can read it without a magnifying glass. So there's no good reason why I stopped after 10 years. You're saying you're going to stop somewhere. You're right, I have to stop somewhere. But do you think I'm being a little unfair to this particular project by stopping after 10 years? How old is Disneyland? That 50th anniversary commercial ran for like 7 or 8 years. Okay? It is now officially 60 years old. 60 years old. It was opened in 1956. It makes more money for Disney now than it did 10 years ago, 20 years ago, 30 years ago, 40 years ago, and definitely more money than it did in the first 10 years. That's Disneyland. Disney World is, what, 1971, which would be, what, 45 years old. Makes more money for Disney now than it did 10, 20. Remember all those horror stories about Euro? You don't because you're too young, but there were the first 10 years of Euro Disney's opening. All these horror stories, most written by people who had no perspective on big infrastructure investments. You know that Euro Disney was actually doing better than Disney World and Disneyland were in the first 10 years. It was still losing money. Why? Because it was a big infrastructure investment and they tend to lose money in the first 10 years. You know when they start to generate cash flows? Around the 10th year. And what am I doing here? I'm killing the project just as it's becoming a cash cow. It is unfair. And in accounting returns, I have to either go 40 or 50 years out, which is a pain in the neck, or just wave my hands and say, don't do anything based on this. But we'll come back and talk about what we can do with cash flows that we could not have done with accounting earnings. So the two things I want you to think about when you look at those accounting returns is you need to compare it to a hurdle rate that reflects the risk of the project and the country it's in. And the second is, it is in a sense a little artificial because I stopped the project after 10 years. And for that reason, I'd like you not to decide against a project. And there's a third factor. What did I say? Good measure of return should be, going back to the Wednesday class, should be based on cash flows, should be incremental, and should be time weighted, right? An accounting return on capital is not based on cash flows, it's not incremental, and it's not time weighted. It's about as far as you can get from a good measure of return. So you think, why do we waste our time on it? Because half of all projects around the world are still based on return on equity or return on capital calculations. Accounting returns still drive a lot of decision making. And you can see the flaws in both, even in this very limited example. Any questions? Yes?
For the adjustment to the cost of capital, is it more important where the project's based or where it's generated?
That's a good point. So you're saying, in fact, that's a great point. I'm putting this theme park in Rio, right? I'm giving it the Brazil country risk premium. The point that, sorry, what's your name?
Greg.
Greg's raising is, what if 50% of the people coming to the theme park are not coming from Brazil? But remember, when I build a theme park in Brazil, it's not for just for Brazilians. It could be for Argentinians, Venezuelans, Chileans. So maybe I should not have used the, I'm sorry, it's something? Colombians too. Yeah. Colombians, we have to check passports twice before we do that. But no. But basically the question, I think you're right. Maybe I should have used weighted average of where you were going to draw your audience, and that's a good point. Maybe I should have done that because that's essentially the truth with Hong Kong. Hong Kong Disney is not just pulling from Hong Kong and China; it's actually pulling from all of Southeast Asia. But that's a very good point. Any other questions? And there's a little bit of a Netflix there, so think about it if you've read the case, right? So the return on capital doesn't look good, but at the same time, it might not be a very, very robust measure. I'm going to take a little, yeah, go ahead.
The cash flows have been presented. There's no terminal value.
Because it's accounting, I didn't present cash flows yet. That's a problem, right? What did I present? So far, we're in the accountant's world, right? I used accounting earnings, accounting book value, accounting return on capital. We haven't even looked at cash flows yet. You can't bring in a terminal value into an accounting earnings number. That's not a good cash flow measure. It's an accounting earnings measure. In fact, I'm going to talk about that's one of its biggest flaws. It's a pure accounting measure. And when people use it as a proxy in cash flows, they've got to be very careful because you're taking an accounting earnings measure and putting it into a cash flow calculation. Now I'm going to take a little tangent. This return on invested capital has taken on a life of its own in the last 25 years. It's become the most widely used metric in many corporate financial analyses, in consulting firms, in banking firms, even in valuation. And here's why it's become a widely used metric. Remember that financial balance sheet that I showed you at the start of the class where I said you can break a company down into assets in place and growth assets? And all of your companies, the companies you've picked on your project, if you look at your company, some of its value comes from assets in place, some from growth assets. It is true when you look at a company, you get all excited about growth prospects. But before you get too excited about growth prospects, one of the fundamental questions you might want to stop and ask is, how good are these companies' existing investments? Do you see why? Because you have a company with a history of taking bad investments. You have to be a little more cautious about assuming they can create value from growth. So one of the fundamental questions that you face in both valuation and corporate finance is when you look at a company and you say, does this company take good projects? Can you answer that question? So I'll give you at least one way you can try. It's not a great way, but it's the most widely used way. Remember how I looked at the project? I took the after-tax operating income and divided by the invested capital in the project, right? What if I took all of Disney's existing projects on the ground? And I looked at all of Disney's after-tax operating income as what these projects threw off as operating income last year. So hold on to that thought. Okay? So this is the collective operating income that all of Disney's existing projects, so Disneyland, Disney World, their movie business, all put together generated in 2013. If I could tell you how much money Disney has already invested in these projects, maybe you can divide the after-tax operating income by that investment in the existing projects. Now that's going to be tough because, as I said, Disneyland was taken in 1956, Disney World in 71, Pixar was bought 7 years ago, Lucasfilms was 5 years ago. All this stuff happened in the past. But if you could somehow figure out what was invested in those projects, then maybe you can divide the after-tax operating income by what was invested to see what kind of return you're making on these projects. Now that's going to be a nightmare for me to go back to 1956, figure out what was invested, adjust for inflation, adjust for depreciation. So I'm going to cheat. I'm going to take the existing book value of equity, because if you think about book value of equity, it's really the collection of all past decisions, with the caveat that accountants have a little bit of play on it. But if I took the book value of equity and I took the book value of debt and added them together, I'm getting a book value of what the accountant has said is invested in this firm. But cash is really not at play because it's not in any project, so I subtract out the cash. So book value of debt plus book value of equity minus cash is called invested capital. It's not a market number, it's a measure of what's actually invested in the company. You divide the after-tax operating income by that invested capital, you get what's called a return on invested capital for the whole company. For Disney, that number is 12.61%. You're saying, what does it even mean? To the extent that I trust my accountants, and that's a big if, to the extent that I trust my accountants, it looks like Disney is collectively making 12.61% on its projects. What does it need to make? I don't know whether you remember, but when we did the cost of capital for Disney as a company, it was 7.81%. At least based on this first approximation, it looks like they're generating 4.8% more than they need to be doing, given the risk of the projects, given the risk-free rate, etc. That's called an excess return. It's a number, right? Let's put some flesh on the number. Why is Disney making 4.8% excess return? I mean, this is something you're going to run into. You're going to compute an excess return for your company. For Apple, for Google, etc., you're going to come up with an excess return. And now it's making a 4. To the degree that you trust that number, what am I saying? It's making 4.8% more than it needs to make. Why is it able to do that? Remember I said every class you've taken in this program or will take is in service of this class. Bring out your corporate strategy class. What's all of corporate strategy about? Let me not ask that question. No, some seriously bad answers would come out. What is corporate strategy at its core about? Comparative advantages, right? Barriers to entry. So when I say Disney has a 4.8% excess return, you know what I'm going to push you on? What is Disney's competitive advantage? What's Disney's competitive advantage? Come on, this is one of the easiest companies to name a competitive advantage on. It's Mickey Mouse. You don't have to look any deeper than that. I mean, it's ingrained in children's minds going back, 80 years, and those children are now grandparents and they still have Mickey Mouse. You can't reproduce that even with $100 million or $100 billion today. That's its competitive advantage. Does that guarantee them an excess return? In 2003, their excess return had dropped below zero. Just because you have a great competitive advantage, if you have bad enough management, you can turn a competitive advantage into dust. They'd managed to do that in the final years of Eisner. It's managed to bounce back now, but if you ask me where does that competitive advantage come from, it comes from those magical brand names. And those magical brand names are not just Mickey Mouse, but also the fact that you now have the Star Wars franchise and the Marvel franchise. You've collected a set of brand names that allow you to charge these higher prices for things and generate higher revenues. That's where the excess return comes from. So when you compute the excess return for your company, don't just leave it as a number. Think about, why does my company have the excess returns that it does? Because that completes the story. When I looked at Vale, its excess returns using the same process was 2.22% in November of 2013. If I'd asked you then, where do those excess returns come from, the answer would have been, it's an iron ore mining company, right? Iron ore is iron ore, so the question is, who has the lowest cost reserves? And Vale had significant low-cost reserves in Brazil to begin with, which it got by doing what? It used to be a government-owned company. It was endowed with those reserves when it was a government-owned company, so it started with an advantage. It then added to that advantage in the last decade by going out and buying, big stakes in Canadian companies and globally. But that's the source of its excess returns. But to show you that this too shall pass, you know what that number looks like now? That was in 2013. Today, Vale earns 5% below its cost of capital because iron ore prices have collapsed so much. Nobody in the business makes excess returns right now. If you look at Baidu, excess returns of 17.63%. Astounding, right? What's the source of Baidu's excess returns? Anybody go to China during the break? No? All of China was avoided? The source of Baidu's competitive advantage is, you get into China, you can't use Google. It's an enforced competitive advantage. The government can be your partner in this process. And if you cannot use Google, it means if you're an advertiser in China, you have to go through Baidu, or you don't go through anybody at all. Tata Motors' competitive advantage is excess returns is 9.55%. Its biggest competitive advantage is it bought in 2009. It's almost entirely coming from Jaguar Land Rover. It's not coming from Tata India. Tata Motors India has actually gone into some really bad times because it's in a very competitive space with very little to separate itself from its competition, but Jaguar Land Rover delivers those excess returns. Finally, Bookscape is barely breaking even. Why? Because I had to raise the cost of capital, because you are not it's not that it's a bad business, but because the owner is not diversified, the cost of capital went higher. So these excess returns are numbers. I know they're snapshots. It's 1 year. I don't want to read too much into them, because in any 1 year, anything can happen. But this, as I said, has become one of the most widely used numbers in corporate finance and valuation, is this ROIC, or return on invested capital. So I'm going to give you some ammunition, because when you get out there, whether it's this summer or when your regular job, you are going to get hit by a lot of talk of returns on invested capital. And here's the cautionary note. I replaced the page in your notes with a kind of updated page, so just when you get a chance, just put it in there. About 3 months ago, I decided to sit down. Started January, actually. I sat down and I looked at return on capital for companies. And as I was looking at them, this red light kept flashing off and on, saying, remember, you're working with an accounting number. So I decided to take all the things that worry me about return on capital and put them on a page. Return on invested capital is basically after-tax operating income divided by that invested capital that I showed you. Book value of debt plus book value of equity minus cash. What should terrify you about return on capital is both those numbers are completely accounting numbers. Numerator is earnings, denominator is book value. So let's think about some of the things that can give you strange-looking returns on capital for companies and what to do about them. First, let's say above the numerator. If you've had any something happened during the last 12 months that can cause your earnings to be abnormally high or low, that can cause your return on capital to be high or low as well. So if you have a company that something really good happened last year, earnings shot up, your return on capital can be great, but it's a kind of number that can swing back. You should expect it to see dissipate. And that you can see if you look across time. You'll have plus 27, minus 15, plus 30, minus 22. Then you know you have something that's swinging around. The second is, it is an accounting earnings number. And it's affected by how accountants miscategorize items. Like what? We talked about leases. We said leases should be treated as financial expenses, but they are consistently treated as operating expenses. We talked about the fix. But the traditional income statements, that fix is not made. I'm also going to argue that things like R&D, which should be treated as capital expenses, are now treated as operating expenses. That can skew your operating income as well. And thirdly, if you have a young company, Say you're doing this for LinkedIn. Don't expect to see a great return on capital, even if the company is doing really well, it's great competitive advantages, because when you have a young company, your income might be low because you're on the verge of this build-up. So if you have a low return on capital, don't be too quick to pass judgment on those companies. Now, if you go below the line, here are the things that worry me about invested capital. What am I trying to compute invested capital? How much money did you put in your project? So if you have a bad project, I can catch it, right? But here's one of the biggest problems with that number. I don't know whether you read, Chevron just opened one of the largest gas plants in the world off the coast of Australia called Gorgon or something. It's like this monster name. It is really a monster because you know how much Chevron actually ended up spending on that plant? $54 billion. You know when it made the decision to build the plant? In 2009. Why did it decide to build the plant? Because oil prices were high and gas prices looked healthy. The plant is just going into operation right now. When the plant decision was made, the oil price was $70 a barrel. Today, of course, it's $40 a barrel. Is this investment a good investment in hindsight? Everybody knows it's not, including everybody at Chevron. But it's too late. You can't get your money back. At this stage, they're going to go with the plant. But sometimes, so when I do my return on capital for Chevron right now, you know what's going to happen, right? The $54 billion is going to go into my invested capital. My return on capital is going to reflect the truth, which is this investment should not have been taken. I can guarantee you sometime over the next year or two, the accountants at Chevron are going to get together and say, this was a bad investment. You know what's going to follow, right? They're going to write off about $25 billion of that $54 billion, saying, hey, we shouldn't have invested this. You're saying, so what? Let's say it's 3 years out. You're looking at the invested capital of Chevron then. You're going to see only $29 billion in the invested capital. You say, that was a really good investment that Chevron made. I hate it when accountants write off mistakes. I know why they do it. But from a finance perspective, I want those mistakes to stay on the books to remind me of all the decisions you made over your history. I want HP to keep that $16 billion they wrote off from acquisitions over the last 6 years to remind me that this is a company I should never trust with my cash. Because they have a horrible return on capital. That is the truth. But because they've written off the $16 billion, their return on capital actually looks pretty healthy. So that's something to worry about, is when you look at a company and you see this astronomically high return on capital, look back in time. See whether they've taken any big restructuring charges or write-offs, because that might explain why your return on capital looks good even though they're not taking good projects. The accounting issues that we talked about with operating income also show up in when I do your invested capital. So when I look at the invested capital of a Target or Walmart, I'm not counting in the debt from their leases, which I should be. And finally, inflation is a problem. See why it's a problem? Most of us in Western Europe or the US, we don't think about inflation in any serious way, because when you have 1 or 2% inflation, you can afford to be sloppy. But let's say inflation is 10%. What's going to happen to your returns on capital? They're going to look really good because your invested capital stays frozen in book value terms, and you're getting inflation kicking into your income. Your return on capital can look good for all the wrong reasons, which is part of the reason when you have hyperinflation, many countries require you to write up your book value as well. You get inflation adjusted book values. But in the US, with GAAP and IFRS, you're not allowed to inflation adjust your book value. So you're kind of stuck with original cost. And if inflation is high, you can end up with great looking returns on capital. So all I'm doing is suggesting is when you see the return on capital for a company in any given year, don't read too much into it. If you see returns on capital that are low for 10 consecutive years, then we can talk about some serious issues. But when you compute the return on capital, keep in mind all those issues that can kick in. So keeping in mind all those caveats, I'm going to do it anyway. We'll do what? I'm going to compute the return on capital in 2015 for every publicly traded company on the face of the earth. 41,800 companies, I compute the return on capital. 1 year. So all the caveats apply. It could be a good year, could be a bad year. I take the operating income, I divide by the invested capital. I did clean up for leases and R&D for every company. And then I also computed the cost of capital for every company. So this is a gigantic Excel spreadsheet, and if you're interested and you want the entire spreadsheet, I'll give it to you. You just have to come and ask me directly, right? So because I'm not supposed to put it online because the data services don't like it. But if I give it to you and say this is an enchilada or a taco, who knows what they would think it is. Yeah? So basically what I did was I computed the return on capital for every company and the cost of capital for every company. What did we say is a measure of good returns? Your return on capital exceeds the cost of capital. Let me start off with the most depressing statistic from this. At the start of 2016, 55% of the 41,889 companies globally earned less than their cost of capital. I have a blog post on this, and the title of the blog post was, "This is the only ad you need for good corporate governance." Because people can talk around, oh, do we really need corporate governance? Do we need activist investors? Do we need managers to come in? I remember about, you know who Marty Lipton is? At least, anybody here from the law school? You know who Marty Lipton is, right? I should be very careful because he's also an overseer. Actually, I don't care if I'm careful or not. He's actually an overseer. He was the overseer for, he was the chairman of the board of overseers for NYU as well. Marty Lipton is a very famous lawyer. In fact, his most famous creation is something you probably heard of. It's the poison pill. Marty Lipton created the poison pill. He's very proud about this. If I were the person who created the poison pill, I'd keep it as secret as I can. But he's very proud about this, and he also feels that activist investors are a horrible development. And his favorite argument is, most companies are well managed, managers are well-meaning, why do we need this unpleasantness of people pushing them and asking them to do things differently? And he makes this claim in panel after panel. So I was in an audience once and he made this claim, and I said, you know what? Is that true? Are most companies well managed? So starting then is when I started creating this graph, because I wanted to counter that notion that most companies are well managed. Because if you look at this graph, what is it telling you? 55% of companies globally are not making what they need to make on investments. So you can give me the defense, which was, it could have been just 1 year, right? Maybe it's just a bad year. You know, 1/3, 33% of this 55% have been earning less than their cost of capital every year for the last 10 years. Every year for the last 10 years. That is a scary statistic. You're saying, how come you can let managers earn less than the cost of capital year after year after year? Let in what sense? If you have bad corporate governance, what's the essence of bad corporate governance? You can have a company that's badly managed and badly run, and you can do nothing about it other than sell your shares and move on. This is what you get. This is why we need activist investing. We need people who are unpleasant to managers saying, you guys need to change. It's not that activist investors are right, even 51% of the time, but they just shake up the process. Force managers to explain what they're doing. In this case, you can see why that's needed. Okay? In fact, I broke it down by region of the world, and you can see that this is true for every part of the world. Okay? Even the US, with its stronger corporate governance, the excess returns are minus 1.3. The surprise for me, the only region of the world where you got a smaller number was India. So don't, whether that's accounting games or whether it's true excess returns, I don't know. But every part of the world, companies collectively are earning less than the cost of capital. And this is with interest rates today. So when people say, well, this must be a great boon when you see lower rates, it's not showing up in the returns. Yeah.
What would happen if you weighted this by the size?
I did a weighted average too. You get about the same number. In fact, it gets slightly worse in some parts of the world. It's in fact the largest companies that lock up the worst excess returns. These are actually aggregated numbers. You know what I mean by aggregated numbers? They are weighted numbers, because what I do is I take the total after-tax operating income for the US, divide by the total invested capital, rather than taking a simple average. Because all you need is one strange company with a 5,000% excess return to everything to get screwed up. So it's in a sense a weighted average of not just money-making companies, but money-losing companies as well. Right? So it's a collective after-tax operating income divided by the collected. But I also have the excess returns by company that you can look at so you can see the patterns across time. So when I report the regional, those are the aggregated numbers. This, of course, is based on individual companies. Okay?
Wouldn't that imply that the global economy was shrinking?
It would mean that it doesn't have to be, because I'm not saying they're losing money, right? What am I saying? They're just making less money than they need to. It just means that as investors globally, we're not looking at... So the way I would read this is don't be surprised to see the market values slide relative to invested capital numbers. So they're making money, but they're not making as money as they need to given the riskiness of what they're investing in. If they were losing money, of course, it would be an even more disastrous scenario. But they have positive excess returns at least, so we should thank God for small blessings. Okay? Any other questions? So when you get a chance, I'll send you the blog post with this in it. Take a look at it because I break it down by sector so you can see which sectors have the most negative excess returns. So if you're an activist investor in the making, you know what you should be focusing on. Take the parts of the world and the sectors that have the worst, most negative excess returns, then take the companies within those sectors that are the worst of the worst. It's a very perverse investment strategy because you're going where things are really badly managed and badly done, saying if I change that company even an iota, that can create incredible value for me. Okay. Any questions? Okay. So when I know I didn't nag you about your project, but there is a project that we've talked about it before. There's a company you're supposedly following, that you should be on. So if you get to this point, whenever you get to this point in the project, compute the excess returns for your company. Take it with a grain of salt. If you can do it over many years, that's better rather than 1 year. If you get a strange-looking number, dig to see whether it's an accounting issue or whether it's truly a function of how the company is taking its projects. Because at least it's a snapshot of how your company is doing. So we've let's go back to the theme park project. So I gave you the accounting earnings, and based on the accounting earnings, it doesn't look like a very good investment, right? 4.18%. But it's earnings. So first thing I'd like to do is get from earnings to cash flows. To get from earnings to cash flows, remember the 3 adjustments you need to make. It's always the same 3. I'm going to add back depreciation and amortization. I'm going to subtract out capital expenditures. And I'm going to subtract out the change in non-cash working capital. Excuse me. Let me remind you again why I'm doing what I'm doing. I'm adding back the depreciation and amortization because it's an accounting expense and not a cash expense. I'm subtracting out CapEx because it is a cash outflow even though it's not an accounting expense. And the change in non-cash working capital just makes my accrual earnings into cash earnings. I've got my cash flow. And now you can start to see something that looks more realistic, which is I get big negative cash flows up front because I'm building the theme park. That shouldn't be a surprise. And over time, the cash flows get less negative. And in year 4, the cash flows start to turn positive. So I'm going to focus in on the adjustments we've just made because there are some very interesting implications that just come from each of these items. So with depreciation and amortization, remind me again what I did. So I took revenues and I subtracted out expenses and I subtracted out depreciation and amortization to come up with operating income, right? And then I took taxes and I came up with after-tax operating income. Now I'm adding back depreciation and amortization. Seems like a big waste, right? If I'm going to subtract it out and then add it back, why not just completely ignore it? Why not do EBITDA times 1 minus T? That will save us some time, right? Why should I not? Why can I not? Why is ignoring depreciation not an option? Because of the effect in taxes. How much of an effect does it have in taxes? Can you tell me? It's actually very simple. I gave you the tax rate of 36%. My depreciation is $50 million in year 1. What is it saving me in taxes? 50 million times 36%, which is 18 million. That is exactly why you cannot ignore depreciation amortization. It looks like it disappears, but it doesn't. It leaves an imprint in the cash flows. How big an imprint will depend on how high your tax rate is. So the higher your tax rate, the greater the benefit of depreciation. So let's play a game. Let's assume you guys have 70% tax rate. You're very wealthy individuals. You're an airline, a publicly traded airline. You're probably losing money, but let's act like you're making money. And let's say you pay the corporate tax rate of 35%. Now, to be an airline, you have to have aircraft, right? I think that's a prerequisite, because if you walk off the gate in an airport right into nothing, serious problems. So you need aircraft. Now, so if you were just thinking like a business, you have to buy aircraft and you get to depreciate it, right? And if you buy aircraft and depreciate it, what do you get as a tax benefit? 35% of whatever the depreciation is. What did I say their tax rate was? 70%. You're saying, what are they going to do with 777s and Dreamliners? Not much, but can you think of a way in which I can exploit their higher tax rates to get a bigger benefit from depreciation? What could you guys do? You could bundle together, but individually you might not have enough to buy a Dreamliner, but let's say 50 of you could get together and buy a Dreamliner. And then you lease the Dreamliner to the airline. You still own the Dreamliner, you get the depreciation on a 70% tax rate. You lose your depreciation tax benefit, but because they get a 70% benefit, they might share some of that benefit with you. That was at the core of the beginnings of the leasing business. In the 1960s, the highest individual tax rate in the US was 70%, in the late 60s and the early 70s. The highest corporate tax rate was 35%. You created the leasing business. You know what almost killed the leasing business? In the 1980s, 1986, the tax rate on individuals and corporations was brought back to 28%. If I do that, there's no incentive left for you to buy an aircraft. Why go through all this trouble? Leasing business exists because you have different tax rates for different groups in the same economy. The higher tax rate individuals will buy the assets and lease it out to the lower and get advantage of the higher tax benefits. So that's why depreciation matters. So when you have a non-cash charge that does not affect taxes, you can ignore it. Like what? Amortization of goodwill. Classic non-issue. Amortization of goodwill in the US is when you acquire a company. It's called impairment of goodwill now. It's pretty much the same thing. And the accountant says, we're going to write off $7 billion. Saying, this is great, I can get a tax benefit. And you cannot. Goodwill amortization is not tax deductible. That's a non-cash charge that doesn't affect your taxes. Any questions on depreciation? Okay. So now let's build on this theme. If depreciation's biggest benefit is a tax benefit, let's think about what kind of depreciation you would like to take as a company. Broadly speaking, there are two ways you can depreciate an asset. The first is you can take your investment and write off an equal amount every year over the life of the asset. So if you have a 10-year asset, you write off, that's called straight line depreciation. The second approach is to get more depreciation up front and less later on. The same total depreciation, but more accelerated towards the early years. So you ready? You're a company, you've just bought a really expensive asset, $1 billion asset. I give you a choice of using either straight line or accelerated depreciation. Initially, I want you to think about your accounting earnings as a company. Okay? Which of these two approaches is going to give you the higher accounting earnings up front? Straight line or accelerated? Straight line depreciation. Which is going to give you the higher cash flows up front? Accelerated depreciation is going to give you the higher cash flow. Now do you see the quandary you face? Because you want to report higher earnings, because everybody loves higher earnings, but you also want to pay less taxes because everybody likes less taxes. Can you have your cake and eat it too? Or can you eat your cake and have it too? You can have two sets of books. And US companies are legally allowed to have two sets of books. Your reporting books, which is what you and I see in the annual report or the 10K, are based upon not the tax depreciation, but what they can claim as reported depreciation. Of course, they've got to tell you they've been doing this because that's where you get the deferred tax. So if you're careful and you know what you're doing, you can catch on, but most people are not. What do you see? Earnings per share, net income looks great. So accelerated depreciation will give you more tax benefits. And you can see why companies want to accelerate depreciation. So any questions on depreciation? Let's talk about CapEx. As I said, CapEx is that negative cash flow. Accountants want to spread it out across time. And CapEx can take two forms. One is that upfront initial CapEx, which everybody thinks about, and this maintenance CapEx, which people tend to forget, and they should. So when you're looking at your cash flow should be after that CapEx. So here's how CapEx works for tax purposes. In the year in which you have the CapEx, you get no tax benefit, and then you get tax benefits over many years as you depreciate that item. So here again, let me give you a choice. Now, in the late 1990s, when AOL was one of the fastest growing companies in the US, if you picked up any magazine and you shook it, an AOL disk would fall out. And you shook it again, 2 more would fall out. At one point in time, half of AOL's expenses were expenses associated with those disks that they put into magazines. So what's so big about that? You took one of those AOL disks, one of my kids did, and he put it into my computer. It takes over your computer. It took me like 2 years to get rid of every trace of AOL. It got people hooked in. You see where I'm going next? Let's assume you are a company like AOL and half your expenses as a company come from these CDs. And you can update this to your social media company example. Your Groupon example now acquiring customers is the same thing. Half your expenses are expenses associated with it. And your accountant tells you that you can actually get away with expensing this or capitalizing. You have a choice. You can say, I can make a case and we can capitalize it. Again, I'm going to ask you a question, first from the perspective of earnings. From the perspective of earnings, would you rather capitalize this expense or show it as an expense right now? Capitalize it because it'll look good, right? Your income. That's what Groupon wanted to do 3 years ago. They said our customer acquisition costs are really not expenses, they're capital expenditures. We're really not losing money, we're making money. Dangerous road to go, but you could see what the rationale was. Now, from a cash flow perspective, though, assuming you have income, and that's a big if, assuming you have income, you want to expense it right now. If you're a small business person, you're actually allowed to expense, I think, up to $50,000 of capital expense. So if basically, let's say you buy a big computer as a small business, you're allowed to expense it. It's one of those little clauses in the tax law designed for small businesses. Do not be crazy and capitalize something when you can expense it, because get the tax benefits right now rather than spreading it out over time. Depreciation looks good on an accounting set of books, but from a tax perspective, it's a pain in the neck. So again, you see the difference between earnings and cash flows. Which brings us to working capital. I mean, we tend to think of working capital as an accounting item, accounts receivable, current assets minus current liabilities. Cautionary note, when you think about current assets, you often see cash as one of the current assets. When you do working capital for projects, don't make cash part of your working capital, because that's going to mean that cash flows you generate will actually make it look like your cash flows leaving. So it's going to be inventory, accounts receivable, accounts payable. Basically, that's it, 3 items. You're saying, why should I care? Anything you have tied up in inventory is wasting, right? So if you look in your store and it's filled to the top with inventory, that's money you can't get your hands on. That's why we care about working capital, is working capital ties up cash. So I'll give you a very simple example. Let's assume you decide to start a used car business. You're sick of this MBA stuff. You're quitting. What's the first thing you need to do? Find a highway with a lot of traffic and find some land off it, right? Because obviously this is expensive. So you're able to lease some land off Route 22, Route 10 somewhere. So you got the land. You put a little hut up for your salespeople. What's the next thing you need to do before you open the gates? You got to get some cars, because you can't have a used car lot without cars saying, come on in, tell me what you want, I'll go look for you. So you got to, let's say you buy 100 cars. Let's say you spend $1,000 a car. It's cheap cars, a used car lot. So you spend $100,000 buying 100 cars. You put them on the lot. You open the doors. Put balloons up, people come in. First day you sell 7 cars. That becomes your revenue for the day, right? So you count your revenues out. Good day. Your number of cars has now dropped from 100 to 93. The first day you can get away with it, but if you're a continuing business, what do you have to do the next day? You have to find a way to replace those 7 cars. So as long as you run this used car business, do you see that there are going to be cars on the lot? And those cars are going to be cash tied up till the day you do what? Shut the business down. And when you shut the business down, you better tell me what you're going to do with those cars, because odds are you're not going to let people come in and just drive away. You're going to have a going out of business sale or something. Do you see what I'm saying? Working capital is cash tied up till you decide that you're going to shut the business down, at which point you got to tell me what you're going to do with that working capital. So if it's inventory, you're going to sell it maybe at cost. If it's accounts receivable, you might sell it to somebody who will collect that money from the people who owe you money. But you can't just leave that loose end out there as a loose end if you tell me your project is over. You know how many businesses go under because they failed to factor in working capital requirements, especially in the retail space? Because here's what happens. You open a store. The more successful you are, the more working capital you need because inventory is going out. You got to keep replacing it. So you will actually go under just because you become too successful. The cash flow drains are so much that you didn't plan for it, and that's what we're trying to do. Is we're trying to plan for those cash flow requirements so that we can raise money up front to cover those needs rather than be surprised 3 months from saying, where did all the cash go? So that's the working capital requirement, and I'm now ready to get my cash flows. So I've got my cash flows. I still have one more step to do. I want to make these cash flows incremental. Let me explain the simplest way to test to see whether something is incremental. Ask two questions. What will happen if I take this project? What will happen if I don't take this project? Okay, what will happen if I take this project? What will happen if I don't take this project? If the answer is the same to both questions, this item is not incremental. It doesn't belong in your analysis. You say, what are you talking about? Let me give you two examples right from this example. Remember the $500 million that I said Disney had already spent on this theme park? I know you don't, but 2 weeks ago I said that it's spent $500 million already. And that it was not going to get this money back if you don't take this project. So let me ask the question. What will happen if I take this project to that $500 million? Nothing, it's already been spent. What will happen if I don't take this project to the $500 million? Nothing, it's already been spent. This project has no effect on it. That's in finance one of those famous buzzwords. What is it called? It's called a sunk cost. And what are we told about sunk costs? Every finance book says exactly the same thing. Ignore sunk costs, right? We'll come back to that. It's easier said than done because I'm going to give you an exercise that's going to be a very painful one, where I'm going to ask you to compute the cost of this MBA program and the expected present value of the benefits you see from the MBA program. And then I'm going to ask you, what are you going to do about it? And you're going to see in a minute what the notion of sunk costs even, why it's so much easier talking in the abstract than about reality. So that's the $500 million. And I'm going to follow the traditional book and say, I'm going to take it out. That's money I've spent already. There's a second item that I want to revisit. Remember that allocated G&A? I said 2/3 of the G&A have nothing to do with this theme park. So let me ask you a question. What will happen if I take this theme park? The 2/3 is going to get allocated to this theme park. What will happen if I don't take this theme park? This 2/3 is going to get allocated somewhere else. The company overall saves nothing from this. So that item should never have been subtracted out. So what I do is I add back that item that I subtracted and think, you know what guys, I should not have subtracted that. Why am I multiplying by 1 minus t? Because I also gave myself a tax benefit on this item, which I'm going to get anyway. So that's non-incremental as well. So that's the added amount. So I've gone from cash flows to incremental cash flows. And that sunk cost is, I'll come back and talk, is perhaps the most difficult concept to deal with in practice. It's easy in theory to say I will ignore what's sunk, but I'm going to come back to that sunk cost. So incremental cash flows, I went the long way. I did the earnings first, and then I went to cash flows, and I went to incremental. If you really want incremental cash flows in a project, there's a much more direct way to do it. Just each item ask, what's incremental revenue from this project? What's the incremental expense? Subtract out the increment. So do everything on an incremental basis. You get exactly the same answer. So if you look at this cash flow, you should get exactly the same cash flows using both approaches because you're getting to the same end game, which is what would the cash flow be to the company from adding on this project. That's the essence of incremental. So let's talk a little bit about sunk costs. Right? Every book you open up Wikipedia, sunk cost is something you already invested in. You shouldn't be factoring into your decisions. I'll make this personal. Let's assume you go to Atlantic City or Vegas, and 20 minutes in, you've lost $500. What's your rational side saying? Get out now, get out really fast. This is not the place for you to be. And then the other part of you says, I'll do it as soon as I get my 500 back. You wait 22 minutes in a line which you thought would take you only 7 minutes. The line's not moved. The fact that you spent 22 minutes is irrelevant, right? Or you should think incrementally, but you say, I've already spent 22 minutes in this line. There is no way I'm leaving. You sign a third baseman for the Yankees for $27.5 million for 10 years because you think he's going to hit 40 home runs for the next 10 years. And then 2 years later, you discovered he's on steroids and he's not hitting home runs and might not even show up to play. You say, you know what? I should be cutting him, but I've already signed this big contract. If I take him off, I look stupid. It's easy in theory to walk away from sunk costs. In practice, sunk costs bedevil decision making, which is once you spend money, it's very difficult to ignore the fact that you've already spent money. In fact, what I suggest to managers when they're looking at projects is don't emphasize what's already happened. Those spreadsheets you show about how much you spent 7 years ago have already laid the foundations for what you're going to do today. Focus on the incremental effect. That's really what should be driving your decision making. But as I said, there's lots of research that suggests it's actually much more difficult to do in practice. Now let me build on this notion of sunk costs because there is a very interesting implication, especially in R&D and test market. Let's say you're a consumer product company. Okay? You've spent $100 million in test marketing. You've already spent it. It's gone. You get to this incremental stage. You're doing the right thing. You say it's all about the future. You look at the future cash flows and the future expenses. And it looks like if you continue with this project, you'll get $25 million from your incremental cash flows. So you've already spent $100 million, it's a sunk cost, but you're going to make $25 million if you continue with the project. Should you continue with the project? Yeah, you're going to make plus 25 going forward, so the answer is yes. But let's say this is the pattern in every single product you have. What's the pattern? You spend $100 million up front, then after you spend the $100 million, you look forward and say, I'll make $25 million. You're going to be in big trouble, right? This is exactly the problem that pharmaceutical companies face. What's the equivalent of test marketing there? You spend the R&D to come up with the product. Once you spent the R&D, it's too late to go back and get it. So going forward, you say, this looks okay. But this is why increasingly in pharmaceutical companies, you're getting an upfront capital budgeting, which the scientists hate. Because what are you asking? When I do R&D, you got to tell me before you spend $1, what you think the odds are that a commercial product will emerge from this R&D. In other words, I need an upfront investment analysis before I let a cost become sunk, because if you wait till the cost gets sunk and then you ask, should I do it, you're going to be doing a lot of investments you shouldn't be doing in the first place. So some of those companies in the 55% that are earning less than their cost of capital, who knows, maybe they're waiting too long in the decision process before they decide whether to invest in something or not, because if you let the bureaucracy is such that the money will get spent first, because they know once the money gets spent, you're more likely to do something than not. So there has to be something that slows the process down. Which brings me to allocated costs. Allocated costs, as I said, is this process of spreading costs that are going to be there anyway, right? And for many big firms, this is a huge item, billions of dollars that get spread around. And since these costs, for the most part, are going to be there anyway, they're not incremental costs. In fact, I'll end today's class with an anecdote because it kind of brings home the essence of incremental. Now, I used to do a lot of banking training programs in the summers. I don't do as many anymore. I've kind of taken them off my calendar. But it used to be that I spent all of July going from one investment bank to another doing their analyst training programs. So 2 days, 2 days, 2 days, 2 days. And by the time I got to the end of July, I didn't know where I was or who I was talking to, but I said the same thing over and over again. And usually by the end of July, I was burnt out and I was just ready to be done. So this was, I don't know which bank, it was July 29th or something, the 25th day in a row I'd been teaching. So I was, it was a 3-day corporate finance session uptown in a hotel ballroom. It's a huge group, 450, I don't know. So it must have been one of the bigger investment banks. So they were burnt out, I was burnt out, nobody was paying attention except for the one guy who was setting up the catering outside the room, the food. So he was the most attentive person in the whole room. So at the end of the second day, he comes to me and says, I've been listening to you. And I said, thank God somebody is. Now, I have a question. So thank God somebody does. He said, here's my question. I'm from Guatemala, and every year I fly back to Guatemala. It costs me about $800. But before I fly back, I go to the Gap or the Limit and I buy seconds. These are clothes with little pieces of damage in them for about $600. Then I sell them in Guatemala for about $1,000. And all my accountant friends tell me I should stop doing this. See how the accounting mind works, right? It costs you $800 round trip. You're making $400 from selling these clothes, so that's a net loss. Don't do it. What's the question you need to ask him before you tell him not to do it? Are you going to fly to Guatemala anyway? And he said, my entire family is there. Of course I am. So I said, let's get this straight. So right now you're flying to Guatemala. It costs you $800. By doing this on the side, you're reducing your expense from $800 to $400. If you listen to your accountant friends, here's what's going to happen. Next year you're going to spend $800 and it's going to be $800. This is why you shouldn't listen to your accountant friends. So remember that when you do incremental, you want to focus not on the bottom line, the traditional profits or loss, but basically on the incremental. Okay?
So I'm very confused. Sometimes you made less than the required rate of return. You're not losing money. Get that. You're losing value.
So you need value that's less than your invested capital. You don't do it because you can trade invested value. So you could have a $20 billion invested capital, and the market value is at 16 billion. You see what I'm saying?
Yeah.
So collectively, you know what money center banks are in price of right? 80% of the capital. What does that mean? Markets not only expect them to keep rating less than the cost of equity next year, but not to cheap. They built into the market price the expectation that these money center banks will never deliver the cost of equity. That doesn't mean they stop existing. It doesn't mean they stop making money. It's that given the money tied up there, they will never. You say one year is liquidate the bank and get the money out because it's liquidation value is not.
Right. But like in an aggregate, I think that's what I was saying. In an aggregate sense, then shouldn't all these companies have less market value?
Even in the 55%.
Yeah.
55%. Collectively, the other 45% will have the Apples and Googles of the world, which will trade at well above the value, right?
Yeah. But you said it was weighted by.
And that's, I think, the question. Why is it a weighted market value? Part of that is that 55%. That's why I said a third of that is continuous. 20-something% of it is the commodity companies, etc., where they're hoping that they'll bounce back in the market. So the market will be hoping to today and may never happen. Right? But those, if you focus in on that one-third, that those are truly basket-based companies, there you definitely see market value less than book value. For the 20% plus, which had negative return on capital for the first time in 2015, anything can happen because people think it's a bad idea.
And you'd expect private companies to be performing even worse, right, because of the required rate of return.
I mean, that's a good question. I don't know what the selection bias in this process is, right? Might be that I would expect them to earn less than cost of capital to compare it to diversified and non-diversified cost of capital, but maybe they're doing better than public companies.
It's just interesting from like a big macro.
So from an economy perspective, it is interesting because it does mean that this notion that companies are immensely profitable, because that's the thing, is capital is making a lot of money, but it's not showing up in the returns. It's not that. So whoever's making money off this economy,